Let's be real. Understanding money can feel intimidating. It's like a foreign language sometimes. But just like learning any new skill, taking control of your finances is within your reach. It's about empowerment. When you grasp basic financial concepts, you make smarter decisions about your hard-earned cash. You're not lost in the jargon anymore. Think of it like this. Imagine trying to navigate a new city without a map or GPS. That's what it's like trying to manage your money without financial literacy. You might end up taking wrong turns, hitting dead ends, and feeling lost. But with a little financial know-how, you become the navigator. You choose the destination and chart your course. Financial literacy doesn't mean becoming a Wall Street whiz overnight. It's about building a solid foundation, brick by brick. Understanding things like market terms, the impact of inflation, and how interest rates work, that's how you build lasting financial peace. It's about taking charge and making your money work as hard for you as you did to earn it. Remember, knowledge is power. And that's especially true when it comes to your finances. So let's dive in and demystify some of these key concepts together. Ever overheard financial news and felt like they were speaking another language? We've all been there. Let's break down some common market jargon. Understanding these terms is like having a cheat sheet for navigating the financial world. First up, market denominations. Simply put, it's about how we measure things in the market. Think of it like units of measurement. We use inches for length, pounds for weight, and in the stock market, we use shares, lots, and contracts. A share is a single unit of ownership in a company's stock, like if you own 100 shares of Apple, you own a tiny slice of the entire apple pie. A lot is just a bundle of shares, usually 100. It's like buying a pack of soda instead of individual cans. Then there are contracts used in options trading, which are agreements to buy or sell an asset at a specific price later on. Knowing these terms helps you understand market conversations better. It's like knowing the difference between a teaspoon and a tablespoon when you're baking. You can follow recipes, or in this case, investment strategies, more accurately. Here's a money trick that trips a lot of folks up. The difference between nominal and real value. Understanding this is crucial for making smart investment decisions. It's like the difference between the sticker price on a car and what you actually pay after taxes, fees, and negotiations. Nominal value is like the face value of something, the number on the price tag. It's the dollar amount you see without taking into account any other factors. But here's the catch. That number doesn't always tell the whole story. Real value, on the other hand, factors in the purchasing power of your money. It considers inflation, which is a fancy way of saying that prices tend to go up over time. So, something that costs $100 today might cost $105 next year. The nominal value is still $100, but its real value has decreased. Let's say you invested in a bond that pays a 5% annual interest rate. Sounds great, right? But if inflation is running at 3%, your real return is only 2%. Your money is growing, but not as much as you thought. This is why it's crucial to consider inflation when evaluating investments. Section 4. Inflation, the silent thief eating your returns. Remember that saying, a penny saved is a penny earned? Well, inflation can make that penny worth less over time. It's like a sneaky thief slowly chipping away at the value of your money. Understanding inflation is crucial for protecting your purchasing power and making wise investment choices. Simply put, inflation is a general increase in the prices of goods and services. Think about how much a gallon of milk or a movie ticket cost 10 years ago compared to now. Chances are, they've gone up. When prices rise, your money buys less. Inflation impacts your investments in a couple of ways. First, it erodes the value of your savings. If you have $1,000 sitting in a savings account earning minimal interest, and inflation is at 3%, your money is actually losing value over time. Second, it affects the returns on your investments. As we discussed earlier, you need to factor in inflation when calculating your real return. So, how do you combat this sneaky thief? One way is to invest in assets that have the potential to outpace inflation. Stocks, real estate, and certain commodities have historically outperformed inflation over the long term. However, it's important to remember that all investments carry risks, and there are no guarantees. Section 5. The Fed's moves. How interest rates shape your investments. Ever heard of the Federal Reserve, or the Fed as it's often called? They're like the referees of the financial system, and one of their main tools for influencing the economy is adjusting interest rates. These rate hikes or cuts can have a ripple effect on the stock market and your investments. Think of interest rates like the cost of borrowing money. When the Fed raises interest rates, it becomes more expensive for businesses to borrow money, which can slow down economic growth. This can make investors nervous, leading to a stock market downturn. Conversely, when the Fed lowers interest rates, borrowing becomes cheaper, potentially stimulating the economy and boosting the stock market. But here's the thing. The relationship between interest rates and the stock market isn't always straightforward. Other factors like company earnings, global events, and investor sentiment also play a role. It's like a big puzzle with many moving pieces. So how can you stay ahead of the curve? Pay attention to the Fed's announcements and try to understand the reasoning behind their decisions. If you're feeling uncertain, don't hesitate to consult with a financial advisor who can help you navigate these choppy waters. Section 6. Real-world wisdom, putting financial savvy into action. Now that we've covered some key financial concepts, let's see how they play out in real life. Understanding these principles can help you make smarter decisions with your money and avoid common financial pitfalls. Imagine you're thinking about buying a new car. The sticker price is $25,000, but the dealer offers you a 0% financing deal. Sounds tempting, right? But remember, nominal versus real value. That $25,000 car will likely depreciate or lose value over time, and if you factor in inflation, you might end up paying more in the long run. Or let's say you're considering investing in a high-yield bond that promises a 7% return. Sounds great, but what if inflation is at 4%? Your real return is only 3%, which might not be worth the risk. These examples show how understanding basic financial concepts can empower you to make more informed decisions. It's not about memorizing complex formulas, it's about applying these principles to your everyday life. Remember, financial literacy is a journey, not a destination. Keep learning, keep asking questions, and keep striving to make your money work harder for you.